Hey folks, Roger Scott here. Now, I talk to traders all over the world. I literally, in the last hour, I've literally spoke to a trader in Japan, Italy, Singapore, and South America. And that's just in the last hour. And one of the most frequently asked questions I get is, Roger, I know you're not going to give me 2 hours of your time. You barely have enough time to answer your emails. Folks, I get 30 emails every hour. It's crazy. And I'm sure you do too. But where am I going with all of this? So one of the most frequent questions I get is, what do you use to gain an edge in the market? Roger, what do you use to gain an edge in the market? Now, I may get this question asked 50 different times, but it all comes down to the exact same question. Roger, what do you use to gain an edge in the market? So I'm going to do a 3-part video series. I'm going to spend the rest of the day with you today talking about the 3 main factors that you can use to gain an edge in the market. I'll do a 3-video series because each one's going to be longer and I don't want this video to be, half hour or whatnot. So the first one will be filtering. Or actually, no, the first one will be how to position yourself with the market so you don't trade against the market. That's number 1. The second video will be on filterings, how to filter your entries. And the third one will be on diversification. So we're going to get into the first one right now. We're going to talk about positioning yourself with the market. In other words, how to trade alongside the market and not against the market. Because if you trade against the market, it's going to be the same thing as trying to swim against against the tide. It's not going to end well for you. All right. If it's you in the ocean, guess who's going to lose? Same thing. If it's you against the market, you're going to lose. But if you're surfing or swimming in the same direction as the waves, the ocean will help you. It'll give you an edge, and so will the market. So that's what we're going to talk about in today's video. Now, I'm going to jump into the lab right now, and I'll share my screen with you, and then I'll come back here for the second video. And folks, I can't wait to do this. This is exciting. So let's go. Let's jump into lab, and we'll go from there. All right, we're back in my lab, and again, I just got out of the other room filming the intro, wanted to come in here and show you, because it's one thing talking and talking and talking, but it's another thing actually going through the chart. Now, I could show you this with any chart, but I happen to be using the E-mini S&P, and you know what I'll do just to make it fair? I'll switch it to the SPY. People know the SPY better than the E-mini S&P, although it's about the same thing. If this thing even turns, I mean, don't you love it when I'm doing a demo, it gets stuck. It doesn't get stuck anytime except when I'm doing a demo, but we got it working. So now we're looking at the SPY, ticker symbol SPY. If you don't know what the SPY is, then you shouldn't be trading. No, if you don't know what the SPY is, then it's the ETF, the exchange traded fund that tracks the S&P 500, okay? So you could either look at SPX, you could look at SPY, you could look at the E-mini S&P. They will all track this perfectly. So the first video, there's going to be 3 videos. This is going to be the first video, and I'm going to be talking about positioning yourself with the market. Now, what in the world do I mean positioning yourself with the market? Well, if you trade stocks, if you don't trade stocks, you don't have to worry about positioning yourself with the rest of the market. Why? Well, if you trade currencies, they don't really have much correlation to the stock market. They kind of do their own thing. If you trade corn, commodities, you don't have to worry about positioning yourself with the market. But most of us trade stocks and stock options. So it's really, really important to understand that when you're trading stocks, you're not really trading the stock in isolation. In other words, you could be right on the stock, but if you're trading a stock that has some relationship to the market, large cap stocks, mid cap stocks, the only stocks that don't have a strong relationship to the overall market are over-the-counter or tiny or really, really smaller stocks. If you're trading stocks that are Amazon, Apple, Roku, Wells Fargo. I'm literally just randomly naming names. But if you trade most stocks, like the average guy out there or the average gal out there, again, Amazon, Microsoft, Intel, all these stocks that are part of the S&P 500, For example, these are constituents: Microsoft, Apple, Facebook, JP Morgan, Alphabet, Google, Visa, Johnson Johnson. I can go on and on and on and on, and you can see this entire list, and anywhere you look, you will find a company that you're very familiar with. I do want to point out that if you look at Apple and Microsoft, just Apple and Microsoft and Amazon and Facebook, these four stocks, can you imagine these four stocks make up the market cap pretty much of the entire 10% of the S&P 500? It's crazy. So, but I'm moving on to a different story. I'll talk about this another time, but the S&P is very, very capitalized by just a handful of stocks. But getting back here, going back to the chart, if you look at the chart of the S&P 500, and I learned this a long time ago, most of these stocks, if you look at a large cap stock, you'll find that it has a correlation, very strong movement to the overall market. Look at Apple, for example. Doesn't look all that different. It's making highs. It just cooled off right here. And if you look at the S&P, you will see that it's pretty much doing the same thing. It's been on a tear till the last few days. So, where am I going with this? If you trade most stocks, you will find that if the market's going higher, it's much easier to get movement from them than going against the grain. It literally is like boogie boarding or surfing. Try surfing against the wave. See how far you get. It's not going to get pretty. The ocean will always win, and you will always lose. Same thing happens here. And I'll tell you a story. I love this story. I haven't told this story in a long time, except for a boot camp that I did, a private session that I did recently. There's this book. It's called How to Trade Stocks. It's written by William O'Neill. He's the author of Investor's Business Daily. This book's probably in its 50th printing by now. It's been around. I think it was the second book I ever read. And he goes really deep into all of these analysis methods. You can buy this book for $10 on Amazon. And he talks about all these things, all these EPS and relative strength. And I was just digging it. I was reading this book, and I thought it was the Holy Grail. And then he literally has, this was 25 years ago. Maybe he's fattened it up. But he literally has this little chapter, and he talks about how if you trade stocks, they're correlated to the stock market by about 70%, which means if you can't get your market analysis right, you're not going to get your stocks right, even if you do get them right, because if the stock market moves down, stocks will move down. For example, the S&P. Now, I have not looked at this ahead of time. I'm totally just thinking out loud, but S&P's been down 3 days straight. If you look, it's been moving up, 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 and last 3 days it's been moving down. So let's look at Microsoft, for example, just randomly. Has Microsoft been moving against the grain? No, it's been just cooling off. So the point is, it's very hard to be right on a stock if you're not right on the market. So let me show you some really simple tools, and this is really a good time to do it right now because the market's in what I believe is a short-term turning point. So, for example, let's just delete this ugly resistance line here. So what I believe, we're in a situation right now where we're overbought. But here's what I like to see. I like to begin accumulating stocks when they just cross above the 50-day moving average right here, right at these levels right here, right at these levels right here. And you don't want to buy stocks when they start getting towards the overbought level too much, when the RSI gets close to 70, and this is a 10-day RSI. So again, you always want to be above the 200-day moving average. If you're not above the 200-day moving average, walk away. If you're not above the 200-day moving average, and you should be probably close to being below the 200-day moving average, that's a good time to look to short stocks. But if you're above the 200-day moving average, that's a good time to be long stocks. That means institutional volume is moving into the market, not outside of the market. So you have the green light to begin accumulating when we're above the 200-day moving average. I prefer to wait when we're above the 200-day, and by default, when you're above the 200-day, you will most of the time, not all the time, this is what I call the twilight zone right here, but most of the time you'll be above the 50-day. At least wait till you're above the 50-day, and that way you get yourself a nice little entry opportunity. And then you don't have to start buying the S&P 500, but you get a green light to start accumulating stocks that will give you that wave, that push from the back. You're going to be surfing in the direction of the wave instead of behind the opposite way. And then when you start seeing the RSI get a little overbought, that's a good time to stop. Now, let's say you're trading to the short side. It's possible, right? For example, let's look at Roku. Not Roku. I had it wrong. Let's look at Baidu. Sorry, earnings on both stocks come out today, and I was talking about both of them, so got a little confused. So again, notice we're below the 200-day moving average. We're above the 50-day line, but again, we're below the 200-day moving average, so this is just a matter of preference. And I believe the stock is going to go lower. Now, if the RSI was right here, and it's not, it's right in the middle, it's actually telling us that it's not the market, this stock is not overbought or oversold. But if the stock market was below the 200-day moving average, I would start looking at stocks that are trading below the 200-day moving average. If the stock market is above the 200-day moving average, which it is right now, it's actually above the 200-day and the 50-day, but it's a little overbought, I would cool off stocks and I would start looking at defensive assets. But the point is, there's a strong correlation. And that's what I learned from reading that book, William O'Neill's book. He gives you all these cool things to apply to stocks. And then he slipped in, by the way, most stocks and sectors have a strong correlation to the S&P 500. So beware of that. If you want to be on the right side of the market, you want to increase your edge, you want to have a winning edge, you want to trade bullish when stocks are bullish, when the stock market is bullish, and you want to trade bearish when the stock market is bearish. So to go long, you want to assure that you're above the 200-day line and possibly above the 50-day line and not overbought according to the 10-day RSI. And if you're trading to the short side of the market, you want to make sure you're below the 200-day moving average and hopefully below the 50-day moving average, like this example of Baidu that I'm about to show you. I think I just rhymed without even trying. Okay. The bottom line is you want to trade stocks that are trading above the 200-day moving average when you're trying to go long, and when you're looking to go short, you want to look at stocks that are trading below the 200-day moving average and that are not oversold. So if you're looking to buy, if you're looking to go long, you want to buy stocks where the RSI is not overbought, and you're looking to sell, you want to make sure that you want to sell when we're not oversold. I hope that helps. In the second video that's coming up next, I'm going to show you how to use filters to increase your win rate when you're going long and going short. Stay tuned for the next video. Again, if you're getting something out of this video, ring the bell, subscribe to this channel, and like this video. And if you want to reach out to me, Roger@wealthpress.com. I hope you're enjoying this channel. Talk soon.